Good morning, students.
Good morning, ma'am.
Students, the topic which we are going to extend today is in regards to the interpretation of the financial statements. In our last lecture, we had started the discussion in regards to the interpretation of the financial statements, and today we are going to extend our same lecture. We had discussed that there are 4 important financial statements which are being prepared by the limited liability companies. And those 4 financial statements are statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, and statement of cash flows. There are so many stakeholders, all those persons and parties who are interested in the business activities are known as stakeholders. There are so many stakeholders who are interested to know about the well-being of a business. How well a business organization is performing can be an area of interest for so many stakeholders. One of the important tools which the stakeholders can use in order to analyze the financial health of a business is known as ratio analysis. Ratio analysis is one of the tools which can be used by the stakeholders in order to analyze the financial position of the organization. By using ratio analysis, when the stakeholders just start to analyze the situation and position of the organization, this is known as interpretation of the financial statements. What is interpretation of the financial statements? It is the analysis of the financial statements, and one of the tools with the help of which the various stakeholders can analyze the situation of a business is known as ratios analysis. In ratio analysis, with the help of different ratios, we can establish, we can determine that how well a business is performing. Ratio itself does tell us the relationship between 2 or more items. What is the standing position of one particular item in regards to the others is known as ratio. Ratio itself is not going to be seen in alone. Whenever we are calculating a ratio, it has to be compared with the position of the competitor or with the position of the own organization as well. The organization can compare the current ratio with the previous periods, with its budgets, with its plans, with its forecasts, or on the other hand, it can compare its ratios with the competitors within the same industry, or it can compare its ratios with the industrial averages in order to analyze that how well the organization is performing. Different stakeholders can have different kinds of interests in the business. Say, for example, investors. Investors are going to be primarily concerned with the dividends, with the share price, with the market share which the organization is having. So as per their interest, they are going to apply different ratios in order to interpret the situation of the organization. Banks, for example, banks will be interested to know about the total profit of the organization so they can get to know that whether the business is in a position to return their principal amount or not, or whether the organization will be able to give the interest payments timely or not. So according to their area of interest, they are going to apply different kinds of the ratios. Creditors are also stakeholders. Creditors will also be interested to know about the financial well-being of a business because they are interested to know that whether the business would be able to return their principal amount or not, whether the business will be able to return their debts or not. On the other hand, debtors would also be interested to know about the well-being of the business. So every kind of the stakeholder will be having different kinds of the interest in the business, and according to their area of interest, different kinds of the ratios could be applied on the financial statements of the organization. The basic nursery to be applied to for the application of the ratios is financial statements. On which particular document the ratios are going to be applied? On the financial statements of the organization. We had discussed that there are four important areas of the ratios. Number one has been the profitability ratios, which we had discussed. Number two is position ratios, which already we have discussed in our previous lecture. Now, the third area of concern is investor ratios. Investor ratios are of fundamental importance for the investors, existing investors, and the potential investors of the organization. Those investors who have already invested in the business and those investors who are thinking to invest in the business could use the investor ratios in order to analyze and interpret the financial position of a business. One by one, we are going to have a look at the investor ratios. The first investor ratio is price to earning ratio. The formula of price to earning ratio is current share price divided by latest EPS. EPS is earning per share. In the exam question, they will be giving you the earning per share by themselves. EPS will be calculated and will be given to you by the examiner. So current share price divided by latest earning per share is known as price to earning ratio. Price to earning ratio, as its name is suggesting itself, it's a ratio of current share price and the current latest earning per share of the organization. It represents the market's view of the future prospects of the share. How well the share price of the organization is performing in the industry will be known to us by having a look at the price to earning ratio. What is the future prospect of the company? What is the future prospect or the proportion of increment in the total share price of the organization will be known to us by using price to earning ratio. If, say, for example, the ratio, the answer to this ratio is lesser or is declining with the passage of time, it means that potential of the share of the organization is very less to grab the greater market share. It is not performing well in the organization. Now, what are the reasons behind the increase in share price or decrease in the share price? There can be so many reasons behind. Sometimes they will be giving you any of the reasons which are resulting in the increase or decrease in the share price, and sometimes they will not be giving you, and you have to assume it by yourself and then you have to comment. Anyhow, this price to earning ratio will be telling us about the relationship of the current share price and the latest earning per share of the organization. And high price to earning ratio suggests that high growth is expected. Now, investors will be using this price to earning ratio at a very high pace. Again and again, they will be using this ratio because there can be two reasons for which the investors just want to invest in the organization. And those two reasons could be capital growth or the increase in returns. Either they do want the share price of the organization to increase with the passage of time so that they can sell that share in the market and they can earn the capital repayment. The capital repayment is going to be by selling the shares in the market. On the other hand, they do want the share price to increase so that the dividends can also be increased on the organization's shares. So these two kinds of the interest could be there from the investor side in the organization. So price to earning ratio could be calculated by them in order to know that how well the share price of the organization is performing in the market. If the answer to this ratio is increasing with the passage of time, the investors would be more attracted towards the organization. And if we do see a decline in this ratio, obviously the investors would not be happy. So the first ratio, which is going to be of primary importance for investors, is price to earning ratio. And the formula of this is, what is the formula? Current share price divided by latest earning per share. If earning per share is not given to you, then you have to calculate it by yourself. What is the formula for earning per share? Can anyone recall or tell me? after tax, that is net profit of the year, divided by total number of shares. Total number of ordinary shares is the formula of earning per share. Then the second ratio which can be of importance and interest to the investors is dividend yield. Dividend yield means, or yield means, a particular return which is given on any kind of investment. Any kind of return given on any kind of investment is known as yield. Dividend yield tells us the relationship of dividend per share and current share price. How much potential does each share is having to produce dividend will be known to us by dividend yield ratio. Dividend per share divided by current share price is dividend yield. It tells us the potential of every share in order to get the dividend, in order to give the return. It is dividend yield. It can be compared, they say, it can be compared to yields available on other investment possibilities. The organizational investors will be looking at different kinds of the investments and the returns which are provided on them. Say, for example, dividend yield will be telling us the return which can be given to them on the basis of the purchased shares. They can compare this return on the different loans, say, for example. The return on the loans can be compared to this dividend yield. So whichever investment will be having the higher potential to give the returns, they will be interested to invest in that. So they say it can be compared to the yields available on other investment possibilities. The lower the dividend yield, the more the market is expecting future growth in the dividend and vice versa. If, say, for example, the dividend yield is getting lower and lower with the passage of time, it means that the market expectations in regards to the returns are increasing. So they say the lower the dividend yield, the more the market is expecting future growth in the dividend and vice versa. And if you see, yes, dear. Yield is the amount of the return which is present on any kind of investment. Okay, so dividend yield, dividend is a kind of a return on the shares. The dividend yield is dividend per share divided by current share price. How much potential each share is having in order to produce a dividend is dividend yield. The next ratio, the most important one, is dividend cover ratio. It's again of primary importance to the investors of the organization. Dividend cover ratio tells us that how many times the total profit of the organization is able to cover the dividend payments. The formula of the dividend cover ratio, as you can see, it's profit after tax, that is net profit of the year, divided by dividends or dividend per share, we can say. So dividend cover ratio tells us that how many times the dividend could be repaid out of the profit earned by the organization. The answer to this ratio will be in the form of times. So the higher the answer to this ratio, say for example, the answer to this ratio is 4. It means that out of the given available profit, 4 times we could give the dividends. So they say this is the relationship between the available profits and the dividends payable out of the profits. The higher the dividend cover, the more likely is that the current dividend level can be sustained in the future. So if we see that the level of this ratio is increasing with the passage of time, it means that organization is in a more secure and safe position. And in the future also, the dividend amount could be sustained. The same amount of the dividend could be given by the company in the future as well. So if we see that the answer to this ratio is just 1, it means that the denominator and the numerator are the same. Out of the available dividends, only 1 time the dividend, the available return which has to be given to the investors could be given. Apart from that, organization's resources will be fulfilled and there would not be any other resources through which the return to the shareholders could be given. So organization's position is not secure. So the higher the answer to this ratio, it means that the investors would be in a more secure and happy position, since they will be knowing that a lot of times out of this particular amount, the dividends could be paid. It doesn't mean that if the answer to with this ratio is 4. So organization will be giving the dividends 4 times to its investors. It means that even 4 times to the current dividend, organization is such a secure position that even if 4 times to the available payment, the dividends have to be paid, organization would be able to do that. So this is the dividend cover ratio, that how many times out of the available profits organization would be able to pay off its dividends. Now, we are done with the ratios. We are done with the discussion of the ratios. Now we have to discuss about the limitations of the financial statements and the limitations of the ratios, limitations of the ratio analysis. We have discussed up till now that we do use ratios analysis in order to interpret and determine the financial position of the organization. But every time, ratios would not be helping us to do so. There are some scenarios in which the application of the ratios becomes limited. The ratios would not be helping us every time in order to analyze the financial position and financial well-being of a business. Because within financial statements, there are some limitations which would not help us to deeply understand the financial position of the organization. So what are the limitations of the financial statements and what are the limitations of the ratios which are dependent upon those financial statements? Now we are going to discuss. Number one drawback and the limitation of the financial statement is in regards to the historical cost accounts. Financial statements are always based upon the historical data. Whenever you are preparing the financial statements, they are not telling you about the future. They are telling you about the transactions which have been occurred in the previous years, in the previous periods. It means that the financial position which is being shown by the financial statements is historical. It is not based upon the upcoming data. So that is why whenever any kinds of the stakeholders are analyzing the financial statements of the organization which are based upon the historical data, their interpretation would be limited. In the future, obviously, there are so many factors which are going to influence the financial position of the organization. And with a higher frequency, the outside environment does change. So here, the limitation of the financial statements does arise. So the past performance could be interpreted, but in the future, how is it going to change could not be interpreted by the different stakeholders of the organization. Whether those are banks, whether those are investors, or any other kinds of these stakeholders, their analysis would become limited. Their analysis will become narrower. On the basis of the ratios analysis, sometimes the stakeholders just try to forecast the future as well. Say, for example, simple ratio gross profit margin. If the gross profit margin of the organization is being remaining lesser than 5% in the past 3 years, on the basis of this data, the organization can forecast that in the future also, this is going to be maintained. But obviously, there are so many factors which could influence this. If suddenly due to the higher inflation, because every country is facing the inflation, if suddenly due to the inflation, the cost of the raw materials does rise, the cost does increases, or say, for example, due to the COVID, which has not been forecasted by any of the organization. Due to the COVID, say, for example, access to few raw materials have been limited since the imports and exports have been banned. So if, say, for example, due to these conditions, the cost has been rising, immediately the forecast of the organization will prove to be a wrong one. So on the basis of the financial statements, the interpretation could not be always right ones because of the limitation of historical cost. The second limitation could arise due to the choice of the accounting policies. I told you so many times that ratios could not be used in order to interpret the financial statements on standalone basis. We have to compare the ratios with our competitors, or we have to compare the ratios with the industrial averages, or we have to compare the ratios within the organization in the previous periods as well. Now, in different periods of the organization itself, different accounting policies could be used. we are going to have a look at the standard IS 8, which deals with the change in accounting policies, where we are going to learn that the organization could change their accounting policies, which on the basis of which they are preparing their financial statements as well. So change of the accounting policies could happen. So if every organization whose ratios are being compared with each other are using different ratios, obviously the comparison would be of lesser, what we can say, limited importance now. It would be a narrower analysis, since every organization has been using different accounting policies. A very small example of this, say for example, one organization is calculating the depreciation on the basis of straight line method, and the other organization is charging the depreciation on the reducing balance method. In the first organization, there would be lesser amount of profits. And in the other organization, there the profits are going to be boosted, since the amount of depreciation is going to be charged at a lesser amount with the passage of time due to the usage of reducing balance method. So only on the basis of change in accounting policy, the organizations are going to have different returns. Anyhow, change in the depreciation method is not an accounting policy. Okay, it's an accounting estimate. But you should be knowing that different organizations could be using different accounting policies and different accounting estimates, on the basis of which their results are going to be different from each other. And this is again the limitation of the ratio analysis. Then the next one, transactions with the related parties. Sometimes when we are preparing the consolidated financial statements, what are consolidated financial statements? Which are being prepared when one organization is acquiring the other organizations. When one organization is having more than 51% shares in any organization, then by law, they are required to combine their financial statements. And their combined financial statements are known as consolidated financial statements. In consolidation, maybe if you can recall the concept of interrelated party transactions. Over there, we had studied that few times the subsidiaries are purchasing or selling the goods to the parent entity. And on the other hand, parent entity could also purchase or sell the goods or services from the subsidiary. In that case, where interrelated party transactions are going to be there, the organizations would not be able to assess the position in a well manner. Because interrelated party transactions in the individual accounts, they have to be shown. In consolidation, we do deduct them. In the consolidated financial statements, inter-party transactions are going to be eliminated. But in their individual accounts, they will be present. And if we are assessing the performance of the organization on the basis of their individual accounts being presented, these inter-party transactions are going to limit the view. Because whenever two parties which are in the same group are going to make the transactions with each other, finally it will not be resulting in any profit or in any loss. Since they are one group, is it? It's just making the transaction with one hand from the other. Two hands are making the transactions with each other. Ultimately, only the single person or the single entity is going to see the profit or losses. So in that case, where intergroup transactions are there, the organization's assessment of the financial statements would be limited. Yes, students. Is everyone cleared? Cleared? Now, additional information. Few times, the additional information is presented in the notes to the financial statements. There are three conditions in which the notes to the financial statements must show the information. If there are few accounting policies which are used in the financial statements and they have to be mentioned, those are going to be shown in the notes to the financial statements. If something has been missed out of the financial statements and it is necessary for the users to be knowing, it must also have to be presented in the notes to the financial statements. And the third condition, if something has been already mentioned in the financial statements but need further elaboration, must also have to be presented in the notes to the financial statements. Now, the requirements to add additional information in the notes to the financial statements are very limited. If you recall F3 concepts as well, we had discussed about the information to be contained in the notes, but to a very limited extent. Standard does tell us about the limited information which have to be presented in the notes to the financial statements. If in some few organizations, detailed notes, detailed additional information is presented, it's well and good. It can tell us about the reasons in the change in the ratios as well. But in the other organizations, if the additional information is limited, we could not analyze them to the deeper extent. Okay, so that could also be the limitation of the financial statements. And the last one, specialized, not-for-profit and public sector organizations. There are few organizations around ourselves which are not-for-profit making concerns. One not-for-profit making concerns are the kinds of the hospitals or the kinds of the schools or colleges. These are not-for-profit organizations. And the other kind of the not-for-profit organizations could be charities, could be non-governmental organizations. Say, for example, we have so many NGOs which are dealing with the betterment of the society. So one kind of the not-for-profit organizations are these organizations as well. Now, the profit and losses statements of the profit-making concerns and not-for-profit making concerns are based upon different principles. Where in profit-making concerns, we are trying to analyze the difference between the income and expenses. In the statements of the not-for-profit making concerns, we are trying to analyze the surpluses and deficits. Where the income of the profit-making concerns is being generated by sales revenue, by selling the goods or giving the services. On the other hand, the income of the not-for-profit making concerns is primarily due to the donations and subscriptions. So their principles on which the income statements or the other financial statements are being prepared are different from each other. So hence the ratio analysis would not be helping us in both the types of the organization. The major tool which we have to use in order to analyze the performance of the not-for-profit making concerns is 3 E's. You have to comment on this in your examination as well, students. 3 E's tells us about economy, efficiency, and effectiveness. 3 E's are efficiency, economy, and effectiveness. In the profit-making concerns, to analyze the financial performance of the organization, we do use ratio analysis, and it can be used because ratio analysis does focus on the financial performance of the organization. But in the not-for-profit making organization, since the major objective is not to earn profit, that is why we could not use ratio analysis over there. We have to use 3 E's in order to judge the performance of the not-for-profit making organizations. Those are economy, efficiency, and effectiveness. What is an economy? The ratio of inputs to the outputs is known as economy. Economy does not always mean to buy cheaper goods or to buy cheaper raw material. It is not always to reduce cost. Economy means over here the ratio of input to the output. The ratio of the input should be lesser as compared to the output. The output which the organization is achieving by the level of the input should always be more. So output should be more than the input. And this is the important E which has to be analyzed in the case of the not-for-profit making concerns. So benefits should always exceed the cost. This is the meaning of economy. Then we have efficiency. What is the meaning of efficiency? Efficiency, can anyone explain me? What is the meaning of efficiency? This has been asked to you in your last exams as well. Everyone has faced this question. Either efficiency or effectiveness. What can be efficiency? Sorry? Multiply? Sorry? Efficiency cost is the cost. Doing the work in time, yes, it could be efficiency. Lower cost. Sorry, which cost? Lower cost. Lower cost is efficiency. No, lower cost would not be efficiency. Efficiency simply means that how well the organization is performing the actions. This is efficiency. Doing the work in time, achieving the objectives is known as efficiency. Whatever stated objectives of the organization are, if those are being achieved and those standards are not being extended, this is known as efficiency. Whatever stated standards are there, if the organization is meeting those, it means that the organization is efficient. Following the law is being efficient, but doing ethics, following the ethics is effectiveness. So one step ahead than the efficiency, we do call an effectiveness one. So whatever the objectives, stated objectives, or the usage of resources in an efficient manner is known as an efficiency. How well the organization is using its resources is known as efficiency. So say, for example, if the organization is having the receivables payment period, receivables receipt period, a lesser one, it is reducing its receivable payment period with the passage of time. It means that the organization is efficient. But in the case of not-for-profit organization, what could be the efficiency? How we are going to judge the efficiency? Whether the organization is efficient or not, how are we going to judge that? We are going to compare the input with the output. What is the ratio, what is the proportion of input to the output could also tell us about the efficiency of not-for-profit organization. Since in the not-for-profit organization, the resources are subscriptions and donations. How well the organization is using that resources in order to produce output means, say, for example, customer satisfaction could be an efficiency. And the last E is effectiveness. Effectiveness is one step ahead than the efficiency. The basic definition of effectiveness is the achievement of objectives. For efficiency also, few times we do say that this is the achievement of the objectives, but more primarily we do say that efficiency is not the achievement of the objectives, but the usage of the resources, how well the organization is utilizing its resources. Whereas effectiveness is one step ahead than the efficiency. If the organization is doing over and above the basic standards, it means that it is effectiveness. How the organization could measure the effectiveness in a not-for-profit making concerns. Customer satisfaction could be the major KPI, key performance indicator, in order to learn that whether the organization is doing its practices in an effective manner or not. Anyhow, we were discussing that financial statements and ratio analysis could not be used in every place, and one of the thing in that was not-for-profit making concerns. We cannot use the ratio analysis in the case of the not-for-profit making concerns. So the tool which we have to use to analyze the performance of the not-for-profit making concerns is which one? 3 E's: economy, efficiency, and effectiveness. Now, students, we are going to do understanding number 2, which is present on page number 604 of your book. Let me just open the book. Students, the requirement of the question, as you can see, it's calculate the ratios for comparator equivalent to those provided by the inter-firm comparison service. Write a report analyzing the financial performance of comparator based on the comparison with the sector averages. So first you have to calculate the ratios for the comparator. Comparator assembles computer equipment from bought-in components and distributes them to various wholesalers and retailers. It has recently subscribed to an inter-firm comparison service. Members submit accounting ratios as specified by the operator of the service, and in return, members receive the average figures for each of the specified ratios taken from all subscribing entities in the same sector. The specified ratios and the average figures for the comparator sector are shown below. Ratios of the company reporting the full year results for period ending between 1st July 2003 and 30th September 2003. So these have been the ratios with which you have to compare your ratios being calculated. Okay, so these are the industrial averages, we can say. These are the ratios of the competitors. Return on capital employed, net asset turnover, gross profit margin, dividend up till dividend cover. Now, these ratios are already given to you. And these ratios you have to calculate by yourself to compare with these answers. You have to apply these ratios on these financial statements, statement of profit or loss and statement of financial position. And then you have to comment on the financial position of the organization. So one by one, start doing it. First, write the formulas for all of these ratios. Return on capital employed. What is the formula of return on capital employed? Who can tell me? What is the formula of return on capital employed? Yes, students. Profit before interest and tax, is it? Or operating profit divided by capital employed. What is capital employed? Yes. Long-term liabilities plus equity could be capital employed, or capital employed could be total assets minus current liabilities. Is it? Then the next ratio is net assets turnover ratio. Net asset turnover ratio. What is the formula of net asset turnover? Sales revenue divided by net assets. Net assets or capital employed. What is the formula of the net assets? Assets minus liabilities. When you do deduct liabilities from your assets, the remaining figure is equity. So net assets is assets minus liabilities. Or net assets could also be known as capital employed. Clear? Then the next ratio is gross profit margin. What is the formula of gross profit margin? Very good. Divided by excellent. Sales revenue multiplied by 100. Students, it is also going to be measured in percentage. Okay, then we have net profit before tax margin. So net profit before tax margin. The formula for this is net profit before tax you have to take divided by sales revenue multiplied by 100. Then we have current ratio. What is the formula for this? Very good. Current assets divided by current liabilities. Then we have quick ratio. Quick ratio is current assets, very good, minus inventory divided by current liabilities. The answer to both of these ratios would be in times. Then we have inventory days. What is the formula of inventory days? Yes. Very good. Inventory divided by cost of sales multiplied by 365. Then we have receivable days. Formula. Very good. Receivables divided by credit sales, or if credit sales are not being given, you can take full amount of sales as well. So receivables divided by sales multiplied by 365. Then we have payable days. Payable days is, yes students, payables divided by purchases. You can take cost of sales over here as purchases multiplied by 365. If credit purchases are not being given, you can take total amount of purchases. If total amount of purchases is also not given, you can take cost of sales. Okay. Then we have debt to equity. Debt to equity is very simple. That is total debt, or we can take long-term debt as well. Because according to the figure which you are going to take, you have to comment them. So it is simply debt divided by equity. Then we have dividend yield. Yes, students. What is the formula of dividend yield? Tell me. Dividend per share. Very good. Divided by latest. And what is the formula of dividend yield? It's not dividend per share. Sorry?
It's dividend per share.
Dividend per share?
Current share. Current share price.
Latest earning per share. Dividend per share divided by dividend per share divided by current share price. Okay. Okay, then we have dividend cover. Yes, what is the formula of dividend cover? Profit after tax. Students, in this dividend cover ratio, you have to take profit after tax every time. You cannot change the figure. You cannot take operating profit instead of profit after tax. Okay, so profit after tax divided by dividend per share. Okay, or total dividends you can also take. So these are the formulas now. These are the industrial averages which are being calculated, as you can see. And these ratios, the ratios which I have written over there, have to be calculated on the financial statements of comparators. And then you have to compare both the results. Okay, the first ratio, return on capital employed. You have to take profit before interest and tax. Profit before tax is being given, but you have to take profit before interest and tax. So profit before tax is 186. If you are going to add the finance cost in that, you will get the profit before interest and tax. Profit before tax is being given as 186. If you are going to add back the finance cost in that, you will be getting profit before interest and tax. Exceptional items, note 2 is being given. Let's see what is written in note 2. They say the exceptional items relate to the losses on the sales of a batch of computers that had become worthless due to improvements in microchip design. Now this is the losses on the disposal of the non-current assets. So are you going to add them also in order to calculate the profit before interest and tax? Yes, students, you are going to add them. Look, they have given us the profit from operations as well. You can simply take 340 instead as well. Instead of doing the reverse working, you can simply take the profit from operations, because profit from operations is profit before interest and tax. But if it is not being given, then you have to take the profit before tax figure of 186, and you have then to add back the finance cost. In exceptional items, since they have written that it is a not for cash item, it's just a loss on disposal. That is why you have to add it back as well. So the profit before interest and tax is 340. divided by capital employed. Capital employed is what? Total assets. Total assets are 1135, is it? Minus current liabilities. Current liabilities are 500, is it? 1135 minus 500 is going to be your capital employed. Total assets minus current liabilities 500. 1135 minus 500 are your capital employed. 635. 635 is your capital. So 340 divided by 635 multiplied by 100 is your return on capital employed. Calculate the answer. What is the answer? What do you mean by positive sign? No, what do you mean by positive sign? The answer would not be negative, is it? Is your answer a negative? 55.95. So yes, we have to take 56. So I am not understanding what is positive sign. Yes, percentage. In percentage, we have to multiply by 100. Have you done multiply by 100? How much? 53.5. So it's 53.5%. Either you can take 54% or you can take 53.5% as well. Now, the return on capital employed with which you have to compare this figure is 22.1%. Is it, students? Now, as you can see, if this is the collected, if this is the right one which you have calculated, because I'm going to comment on the answers which you are going to calculate. If you can see that the industrial average of the return on capital employed is only being 22.1%, but the ratio which we have calculated for return on capital employed is 53.5%. Why is it so? Because our profit before interest and tax has been very high. Why it has been higher? Why it has been very high? Since the losses on the disposal have been there. And that is an exceptional item. Every time the loss is not going to be faced by the organization. This could be the reason for this, return on capital employed. If you can see that the profit from operation is 340. Other operating expenses, they have given. The other operating expenses, there could be depreciation as well. Am I right? In other operating expenses, you could have depreciation also. And for those assets which have been disposed of, we do deduct the depreciation as well. Accumulated depreciation on the assets which have been sold off is going to be eliminated. Do you remember IAS 16? When we are going to dispose of any asset, its relevant accumulated depreciation is also going to be eliminated. In the previous year, organization must have been taking the depreciation on the asset which in the current period is now being sold off. It means that the current year depreciation has now become lesser. If the current year depreciation has become lesser, our operating expenses have also been reduced. When the operating expenses have been reduced, our profit from the operations have increased. Is it? But since the disposal of the asset could not happen every year we are not going to see the increase in our return on capital employed. Am I right, students? So that could be the reason of the increase in return on capital employed as well. Okay, now the next ratio which you have to calculate is net asset turnover ratio. So what is the sales revenue? Sales revenue, as you can see, it's 2,425. 2,425 is our revenue, and net assets which you had calculated were 635. Is it? Capital employed is 635. So 2,425 divided by 635. Calculate it. 3.81. What does that mean? The revenue of the organization is 3.81 more, 3.81 times more than the capital employed. It tells us about the efficiency of the company. Company is using its capital employed with the higher efficiency. Why? Because more than 3.81 times its capital employed, the organization is earning revenue. By using the capital employed, the organization is able to increase its revenue by 3.81 times, nearly 4 times. What is the industrial average? Net asset turnover is 1.8 times. Again, students, what does that mean? The organization's net asset turnover is higher. It could be because the organization's capital employed is becoming lesser with the passage of time. Has it reduced? The capital employed of your company, has it reduced? Yes. Your assets, because the asset has been disposed of during the current year, the capital employed has decreased. That is why the net asset turnover of your company, the company under consideration, the company for which you have calculated the net asset turnover, has increased. The denominator, when the denominator is going to decrease, the ratio is going to improve. Is it, students? Or on the other hand, if the numerator is increasing at a higher pace than the denominator, even then your ratio is going to increase. So since the asset, one of the asset has been sold off, the net assets of the company have reduced. That is why the net asset turnover is now increasing. That could be the reason. The next ratio, gross profit margin. What is the gross profit of your company? 555. 555 divided by sales revenue, that is 2425. 555 divided by 2,425, multiplied by 100. 22.88. And the gross profit margin of the industry is 30%. It means that the gross profit margin of your company is lesser than the industrial average. What does that mean? The organization, your organization is not able to control its direct expenses in a good manner. Because the organization's control over to the direct expenses is lesser and the operating expenses are increasing with the passage of time, that is why the gross profit margin has declined. The gross profit margin is lesser than the industrial averages. Since the only 1 year data for the organization has been given to us, we cannot comment deep. But with the help of the data which is being given to us, we can comment that because the cost of sales are increasing at a higher pace as compared to the revenue of the company, that is why gross profit margin is lesser. We have to see that in cost of sales, what items do we have? One item is depreciation. It could be depreciation, and no more information has been given to us. So we can just comment that gross profit margin is lesser than the industrial averages since the organization is not able to exert a good control over its direct expenses. When it is going to exert a good control over its direct expenses, the direct expenses are going to reduce and gross profit is going to increase. When the gross profit is going to increase at a higher pace as compared to the sales revenue of the organization, it will show an increase in the gross profit margin. Clear? Now the next ratio is net profit margin. And net profit before tax you have to take. Net profit before tax is 186. Is it? Net profit before tax is 186 divided by 2,425. Multiply by 100. How much it is? 186 divided by 2,425 multiplied by 100. 7.6. You can round it as well. It can become 8. Okay, 7.6. And the industrial? one is 12.5%. The industrial net profit margin is higher, and it has a very apparent reason. It has a very apparent reason because when you had calculated your profit before tax, you have deducted 120 exceptional item as well. And this exceptional item was related to the loss or disposal of the non-current asset. Every year, the organization would not be selling its non-current assets. So hence, this exceptional item would not arise every year. If without this exceptional item, if you calculate your net profit margin, 186 plus 120, do it. 186 plus 120 divided by 2425. 2425? Yes, divide by 2425. Then what is your net profit margin? No, dear.
186.
186.186%, no, dear.
12.6.
186 plus 120. Done. Divided by 2425. 12.6%. Now see, if you are going to calculate your net profit margin by including that loss on disposal, now your net profit margin is more than the industrial average. So that decrease in the net profit margin is only because of the inclusion of loss on disposal. Because this loss on the disposal has occurred, which has reduced the net profit margin. And that is why the organization's net profit margin is apparently seen to be lesser than the industrial averages. Since this item is not a frequent one, it is not going to happen again and again in the organization. In the later years, we are going to see a good performance by the organization. If this item would not have been there, and even then the organization has decreased net profit margin, then the reason is that the organization is not able to exert a good control over to its indirect expenses as well. Because the lesser the net profit, it means that more the indirect expenses are there. So if this exceptional item would not have been there, even then the net profit margin is lesser than the industrial averages. Then the reason behind it that the organization is not able to exert good control over to its indirect expenses. And indirect expenses could be its depreciation, its salaries, which it is given. It can be due to the higher interest costs as well. Okay. Now, students, the next ratio which we had calculated is current ratio. Current ratio is current assets over current liabilities. So what are current assets? Current assets, as you can see, 595. 595 are current assets divided by current liabilities. Current liabilities are 500. So 595 divided by 500. 1.1. 1.1, and industrial average is for current ratio 1.6, and your is 1.1. 1.19. 1.19. No, you have to take it 1.19. You can take it 1.2 as well. It's okay. 1.2, even if you are taking 1.2. Now there are two things in this particular point. 1.2, as per so many theorists, if your current ratio is 1.2, the organization is in a secure position. It means that organization is having 2 times more, 1.2, 0.2 times, 20% more assets than its current liabilities. Whenever the current liabilities are going to fall, the organization would be able to pay them back. 1.2 means that organization is having 20% more current assets than its current liabilities. As you can see, the current assets have been, current assets are 595 and current liabilities are only 500. It means that 95,000 more current assets organization is having in regards to its current liabilities. Organization is in a safer position as per most of the theories. Whenever the current liabilities are going to fall due, organization would be able to pay them back. What are the current liabilities? It could be trade payables. It can be interest amounts, any kind of accrued interest, any kind of accrued payments, etc. Whenever those short-term liabilities are going to fall due, organization would be able to pay them back. But if you can compare the industrial average, it is 1.6. In the industry, normally 60% more current assets are being retained by the organization to fulfill its current liabilities. It doesn't mean that the organization is falling behind than the industrial averages. Maybe the organization, instead of holding the amount of the cash in the current asset, it has invested it somewhere. See if the organization is having investments. Let's see in the non-current assets. Okay, no, organization is not making any kind of investments as well. Even the organization is not having cash also. So now over here means that the organization is in a less safer position, because instead of having cash, organization could make the investments as well. If that is the case, it's good. The organization could be earning out of the investment instead of having the vacant cash, so that whenever the debts are going to fall due, they are going to fulfill. But in this case, as you can see, your organization has not invested. Can you see anywhere in non-current asset? Maybe in the non-current asset, we can see that the organization has purchased something. But in the exceptional items, we have seen that the organization has not purchased an asset, but it has sold one of the assets as well. So it means, on the other hand, the organization is not having a cash as well. No cash. And cash is the survival of the business. Cash is the survival of the business. Even if the organization is having a profit of the year is $96,000, even then the organization is not in a safe position. So it means that the organization has to increase its current ratio. On the other hand, let's see the position of the receivables. Receivables are 320,000. 320,000 is a bigger amount as compared in comparison to the sales revenue of the organization. Out of 2,425,000, 320,000 sales have been on the credit. That is why the organization is having the receivables of 320,000, which could mean that the organization is not able to recover its debts from the receivables. That is why the organization's current assets are increasing daily. And if those receivables are going to become irrecoverable, then the organization will be left with nothing. Current assets are going to be more deteriorated, and it could be lesser than 1 as well. And as soon as the current ratio is going to fall lesser than 1, organization would be very insecure. So the organization has to work on its credit limits. It has to improve its credit policy. It has to see that from which particular sources it can gain the cash as well. Since the organization's position is not secure, quick assets, the major quick asset, that is cash, is not present. That is a liquid asset. So liquidity position of the organization is not a good one, since it is not having any cash. Then students, the next ratio is quick ratio. Let's see the quick ratio. What is the result of it? Quick ratio is current assets 540 minus inventory 275. 540 minus 275. No, 540 divided by 275. $540 minus 275. $216 divided by current liabilities. Current liabilities are 500. 0.53. Now see the position of the organization. It's more worse. Quick ratio is 0.53 ratio 1. It means that the ratio of the quick assets to the current liabilities is only 0.53. Organization is almost having 50% lesser quick assets to its current liabilities. It means that major amount of the cash is being invested in inventories. And if more amount is being invested in the inventories, it's again a worse situation for the organization. Because inventory may or may not be sold in time. When we are going to calculate inventory days, we would be able to analyze more. If more amount is being stuck in inventories, the organization is at the disposal of its sales then. If the organization would not be able to make its sales in a proper time, the inventory could become obsolete. And in that case, organization's major amount is going to be lost. So if the organization is reducing its current asset by the amount of the inventories, the quick ratio is only 0.53. It means that the organization situation is not a good one. Let's compare it with the industrial average. Industrial average of the quick ratio is 0.9. It means that it is falling behind than the industry as well. Normal policy which is prevailing in the industry is to have the quick ratio of 0.9 to 1. And 0.9 to 1 is still not a good one. It must at least be equal to 1 or 1.2. But as compared to your company, industry is having a good position. So 0.53 means that the organization is not a safer position. Organization could face the adverse situation, and the lesser the quick assets, the more chances, the more risks of the going concern are also there. The organization would not be able to run in the foreseeable future. So if the organization is having very lesser cash, or if the quick assets, quick ratio or the current ratio is being declining with the passage of time, it means that in the future the organization would face difficulty to fulfill its debts as they are falling due, and the organization would not be able to run as the foreseeable one. Okay. Now the next ratio which we have to calculate is inventory days. So inventory divided by cost of sales. Inventory is how much? Inventory is 275. 275 is inventory divided by cost of sales. Cost of sales is 1875. Since you can see that they have not given us the breakdown of the cost of sales. So we have to take this full figure. So inventory is how much? 275 divided by 1870. How much it is? Multiply by 365. Have you done? 54 days? 54 days, which is a very large number of days. Inventory days for the industrial average is 46. 54 days you got? It means that organization is normally taking 54 days in order to convert its inventory into sales. At least for 54 days, organization has to hold the inventory in its storehouse before making the sales. For 54 days, it has to spend money on the storage cost. For 54 days, it is losing the interest which could be earned on the amount which is being stuck into the inventory. If the organization could not have spent into the inventory, it could have spent the amount by investing somewhere, maybe by giving the loan to someone and getting the return as well in the form of interest. So in that case, organization is losing that amount of interest for 54 days as well. That is the cost of holding cost of inventory. Do you remember economic order quantity? In that, holding cost has been there. So the holding cost of the inventory does include the interest as well. Interest on that particular amount of inventory as well. Because instead of spending on the inventory, organization could have spent that amount somewhere in order to earn interest. So for 54 days, organization is losing the amount of interest and is spending more on the storage cost as well. So it's again a difficult situation for the organization, since in the industry, the inventory is normally converted into the sales in only 46 days. Organization is nearly having 8 more days as compared to the industrial averages. So it can face the drawbacks as well. Then the receivable days. The next ratio is receivable days. Receivables, how many receivables are there? 320 divided by revenue. You have to use the credit sales. Since credit sales are not given, you have to use this whole amount, 2,425. So 320 divided by 2425, how much? 48 days. Now, your receivable days are 48 and industrial average is 45 days. It means that your company is having 3 more days in order to receive back the amount from the receivables. The organization is taking 3 extra days in order to recover the amount from the receivables. It means that the organization has to invest in its credit policy. In its credit control department, the organization has to invest. It has to control, it has to exert a control over to its credit policy. It can offer the cash discount, settlement discounts to its receivables as well, so that they can give the amount in time back to the organization. On the other hand, we have to see the profitability ratio as well. When we had calculated the profitability ratio, the gross profit margin when we had calculated, what has been our answer? It has been lesser than 30%. Is it? It means that the organization is not overtrading as well. If your gross profit margin is increasing, the one reason could be that the organization is overtrading. Overtrading means that the organization is making heavier sales so that credit sales as well. Heavier credit sales so that more customers could be attracted towards the organization. In that case, even if the revenue is larger, the cash position could be deteriorated. So one of the reasons behind the increased gross profit margin could be overtrading. Maybe the organization is overtrading since cash situation is very worse. But on the other hand, receivable days are also lesser, are also more. It means that the organization is not able to recover its debts from the receivables in a time. So the organization has to control its credit limits. Otherwise, there are more chances that the receivables are going to become irrecoverable and the organization situation will become more worse. If more receivables are going to be written off, it means that the current assets are going to become more lesser. And if more current assets are going to fall, your current ratio could also be lesser than 1. As we have seen in the quick ratio as well. Let's move to the other ratio, payable days. Payables. Trade payables are 350,000. 350 divided by cost of sales, 1870, since purchases are not given to us. Is it? So we are going to use the cost of sales. 68 days. Your payable days are 68. Industrial average is 55. It means that the organization is taking more time to repay its payables as well. Now over here in this scenario, it can be a major area of concern. The organization is taking more time to pay back its payables since organization is not having any cash. Organization is out of cash. That is why organization is facing problem to pay back its payables. More situation is that the organization's current ratio is also lesser than the industrial averages. And if we do see the quick ratio is lesser than 1. It means that the organization is heavily facing the going concern issue. There are high chances that the organization is going to collapse in the future. Since the organization is having no cash, quick ratio is also declining. With the passage of time, organization will be facing the bankruptcy situation as well. Organization could become insolvent as well. So the organization has to improve its situation. Organization has to see that how can it increase its current assets. Current asset doesn't mean inventory or receivables over here, because organization is already having inventory and receivables at a higher amount. Organization has to increase its cash. So receivables must be converted into the cash. Inventory must be sold in order to convert it into the cash so that organization would be able to increase its liquidity. Moreover, if the organization would not be paying its payables in time, in the long run, they would not be happy with the organization, they would not be supplying the goods to the organization. They will be terminating the contracts with the organization. So once the contracts are going to be terminated, organization is again going to face a heavy problem. And if it's a manufacturing concern, if it is not going to get its raw materials from the payables from the suppliers in time, its manufacturing is going to face the situation of bottleneck. Okay, so the bottleneck situation is going to be the organization does need to manufacture more, but since it is not having enough raw material, its production is going to be stopped. Again, it will be facing a difficult situation. Then students, next ratio is debt to equity. Debt, total debt of the organization, long-term debt we can take, or we can take the short-term debt as well. If you have to take total debt, then you can take 365 both, but I suggest you to take the long-term liabilities only. 300 is the total debt divided by total equity is 335. 300 divided by 335. 300 divided by 335 is 0.89. It means that organization is having 11% more equity than the debt financing. As you can see, equity financing is 335, whereas debt financing is 300. What does that mean? If the debt financing is lesser, it means that the gearing position of the organization is more secure, because the returns on the debts are must to be paid and the returns on the equity are not must to be paid. So normally there must be a balance between the debt and equity financing of the company. Since the debt financing is having fixed interest payments, it would be bringing more risk to the organization. Like the condition the organization is facing without any cash. If the debt financing is going to increase, the organization would be facing difficulties because interest payments have to be paid. Organization is not having cash, how it is going to pay it? But again, on 300, 8% loans, 8% interest has to be paid. The nominal rate of interest is 8%. So 300 multiplied by 8% has to be paid at any cost. If it is having more cost involved, it is going to be, it has to be contained in that as well. As you can see, the loan finance cost of the organization, finance cost is how much? 34. Every year, 34,000 amount has to be paid as the finance cost. And if the loans are going to increase on the organization would be facing more difficulty because finance cost is must to be paid. At any cost, it has to be paid. So organization is having 11% because 0.89 debt to equity ratio is there. It means that organization is in a secure position. Let's see the industrial average. Industrial average is 40%. It means that organization is normally in the industry, the debt to equity, the ratio of the debt to equity is 40%. So again, the organization situation is very worse. Again, the organization situation is very worse. Your ratio is 86%. Is it? 86% of the equity financing is being invested in the debt. In the industry, the debt is only 40% of the equity financing. It means that industry is more secure. It simply means that debt is 60% lesser to the equity. So your organization is again facing difficulties. Dividend yield, calculate dividend yield. Dividend per share. Interim dividend is 60,000, final dividend is 30,000, total is 90,000. Dividend is 90,000 divided by earning per share. This is the market price of the competitors' share are $6 each. They have to rent. So calculate it 90,000, 90 divided by 6. Sorry, 15 times. 15 times 15%. Have you multiplied it with 100? No, then don't do this. Wait. You have to calculate dividend per share. $90,000 is the dividend. A total number of shares are 150,000 divided by 0.25. 25 cents each share has been there. So 150,000 divided by 0.25. How much number of shares are there? 150,000 divided by 0.25. Great. 600,000 are the number of shares. Okay. Dividend per share 90,000, 90 divided by 600. 0.15. 0.15 is the dividend per share. Now 0.15 divided by 6. Earning per share. Multiply by 100. It's 2.5. 2.5%. It means that the organization is having the potential of producing the dividend of 2.5% only. It means that the organization's share price is not performing well. Organization's share price is not performing well, and the organization's share is not having the potential to produce dividends in the future. As you can see, the dividend yield of the industry is 6%. It is having more potential. They have not given us the information, but if the deeper information could be given, we can see that how much share price of the industry is being there. So simply dividend yield means that the organization's share potential to produce the dividend is not high. Then the dividend cover ratio. Dividend cover ratio, profit after tax, 96 divided by dividend, total dividends, 90,000. 96 divided by 90. 1.06. It means that organization's profit is in a position to cover its dividends only up to the amount of 1.06. Around 1 times, we can say simply by rounding it, organization would only pay 1 time dividends out of the profit which it is gained. So in the future, if more profit after tax is going to reduce, organization would not be able to make its investors happy as well, because they would not be in a position to make the dividends payment. So with this, students, we have finished the topic. Now, more discussion has been done on this question because these discussions you have to do in your examination as well. Okay. Now, students, we are going to move on to our slides. We are done with understanding number 2. Now, students, few times we are acquiring the subsidiaries during the year. It is going to affect our consolidated financial statements as well. Let's see what they say. Subsidiary acquired during the year, statement of profit or loss. Incomes and expenses should increase due to the new subsidiary being included in the year. So when this is going to be the case, when the organization is including its subsidiary, is purchasing or acquiring a subsidiary, and the subsidiary's incomes and expenses are also included in the group's financial statements, obviously the overall ratios are going to increase. The overall ratios are going to increase. So one of the reason behind the increment of the ratios could be that the subsidiary has been purchased during the year. Then this will not have a full year results from the subsidiary, as the result will only be consolidated from the date of acquisition. Students, sometimes in the examination, if they are going to make a very complex question, they are going to give you a group financial statement in which you have to see that the results of the subsidiary as well. If the subsidiary has been acquired during the year, the incomes and expenses of the subsidiary are going to be added only after the time of the acquisition. So you have to make these calculations as well before to calculating ratios. So if there is a subsidiary being given in the examination question, then you have to apply the principles of the consolidation as well. So do not worry, because we are yet to learn about the consolidation in detail. In F7, we have consolidation to be discussed in detail. So after that, you will know that in order to interpret the consolidated financial statements, how are we going to undertake the principles of subsidiary. So acquisition costs may be included, which affect the performance of the group in the current period. Because when we do invest in a subsidiary, we have to write that investment in the group financial statements. Is it? We have to write those in the group financial statements. In the parent's financial statements, they are going to be written. From the group, they are going to be deducted investments in the subsidiary. But in the individual financial statements of the parent, that amount of the investment has to be written. So this again is going to bring the changes. Then margins will be affected, as the newly acquired subsidiary is likely to have different margins to the rest of the group. So the margins of the subsidiary are also going to affect the margins, the gross profit and the net profit margins of the parent company as well. In the case of SOFP, 100% of the assets and liabilities of the subsidiary will be consolidated at the reporting period, like we did. When we do consolidate the SOFP, 100% of the assets and liabilities of the parent and the subsidiary are being accumulated. Then this will mean that there could be significant increase in the assets or liabilities depending on the position of the newly acquired subsidiary. So if the position of the newly acquired subsidiary is well and good, the organization will be facing a good effect on its calculated ratios as well. And if the assets and liability situation is worse in the subsidiary, organization is going to face the worst effects. They say working capital ratios. What are working capital ratios? All those position ratios which we have calculated. Receivables days, payable days, cash operating cycle, all are working capital ratios. Working capital ratios such as receivables collection period are likely to change due to the new subsidiary having different credit terms to the rest of the group. So what are credit terms? It is related to the credit limit. How much time is allowed to the receivables to repay back the debts? So the subsidiary credit terms and the parent credit terms could be different, which is obviously going to affect the receivables collection period as well. Clear? Now students, there is a last question, understanding number 3 and 4, which are present on page number 610. This is your homework. You have to finish them from your notes. With this, we have finished this chapter. Students, we were supposed to take a break of 10 to 15 minutes in between, but since we are getting late, that is why I have to finish this, okay? We are not going to have a break today. Okay, chapter number 10, we are going to start, that is foreign currency. It is a very small standard and it is not being discussed in detail in F7. The detail of the foreign currency, a lot of detail of the foreign currency, you will be having it discussed in F9 in financial management. So this is a very small standard IS 21 of foreign currency, change in foreign currency, okay? Change in foreign currency rates. IS 21, we are going to discuss. A very interesting and small standard. That is IS 21, the effects of changes in the foreign exchange rates. As you are, all of you are experts here in UAE. So you all know that foreign exchange rates do change and how do they affect your financial situation. Is it? Like say for example, nowadays, the exchange rate of Pakistan's currency is becoming lesser and lesser. The currency of the Pakistan is deteriorating these days. So it is going to give you a positive impact because the dirhams which you are going to send back at your home are going to be converted in a large amount of the value in rupees. So similar situation could happen with the organizations as well. They also face the foreign exchange rates situation in their daily lives. Especially when they are purchasing the imports, when they are importing the raw materials from other countries, or on the other hand, if they are having their subsidiaries or their acquisitions in the other countries as well. If we do see the major groups, say for example, Nike, or if say for example, we do see Carrefour, these are the multinational groups. These are dealing in more than one country. So obviously they are having operations in different countries. So IS 21 is going to be applied in these type of companies in which the multinational operations are being carried on. So what is the effect of the foreign exchange rates changes on the companies? This is going to be discussed by this standard, IS 20. How the organizations are going to account for the changes in the foreign exchanges we are going to discuss in this standard. So IS 21, the effects of changes in the foreign exchange rates. In this chapter, we are going to learn about the initial treatment when the foreign exchange rate is going to be changed. What is going to be its initial treatment in our books of accounts? What are going to be the situations in the case of at the time of settling the transactions? Obviously, we have to initially measure the amounts in our books of accounts. If say, for example, we here in UAE, we are importing something from USA. At the time of this initial transaction, We have to report the amount, we have to measure the amount and write it in our books of accounts. If say, for example, we had purchased on credit and after 2 months, we have to pay back the amount to USA. After 2 months at the time of settlement of the transaction, what change we have to bring in our books of accounts? That is the subsequent measurement. So at the time of settling the transaction, what are we going to do? And what are we going to do in the case of the unsettled transactions? So these three important things we are going to discuss in this chapter. They say the objective of IAS 21 is to produce rules that an entity should follow in the transactions of the foreign currency activities. It is only individual transactions in the foreign currency that are examinable in FR. So individual transactions means that only the transactions in the case of the parent or in the case of the subsidiary, not in the case of the group. What is it? What is the treatment in the case of the group? We are not going to study in FR. That would be discussed in your SBI P2. Okay. So IAS 21, obviously the objective of IAS 21 is to make you people eligible to give the accounting treatment in regards to the foreign currency in your books of accounts. This is the objective of IAS 21. Now, few definitions we are going to learn in regards to IAS 21. The first definition is in regards to the exchange rate. We simply say an exchange rate. But under exchange rate, we have further few terms which we should be knowing. Number one, exchange rate is historic rate. What is a historic rate? Historic rate, students, is also known as spot rate. The other name for historic rate is spot rate. You must be memorizing these terms. If you are not memorizing these, obviously in the examination you could be confused. The other name for the historic rate is spot rate. What is a spot rate? It is the exchange rate at the time of making a transaction. If you are making a transaction with the other country, what has been the rate at that spot? That is a historic rate. So they say historic rate, a rate in place at the time, at the date the transaction takes place. Sometimes it is referred to as spot rate. So at the date of the transaction, say for example, today, you being in UAE, making a transaction with USA, what has been the exchange rate for US dollars to AED is today, is the spot rate, is the historic rate. Then we have closing rate. Closing rate is the rate, exchange rate at the reporting period ending date. If say for example, you are preparing your accounts from 1st June 2021 to 31st August, 31st, but it would be May, 30th May 2022 to 23. So what has been the rate at 30th June 2023 is the closing rate. So closing rate is the exchange rate at the reporting time period, at the reporting date. Average rate. Average rate is the rate, is the average of the opening and the closing rate. So at different time periods, we can calculate the average rate. Opening rate plus closing rate divided by 2 is average rate. So average rate is throughout the accounting period. Again and again, you can calculate the opening and closing rates, and you can see the average of this, that is the average rate. So three terms under exchange rates we have discussed: historic rate, which is also known as the spot rate. Then we have discussed the closing rate, and the third one has been the average rate. Then assets and liabilities. We do know what are assets and liabilities, but in the case of foreign currency, they say about monetary items and non-monetary items. What are monetary items? These are the quick assets. Monetary items are those items which are already in the form of cash or can be easily converted into the form of cash. So monetary items that can easily be converted into the cash, that is receivables, payables, loans, which are already in the form of cash or can be easily converted into the form of cash, current assets. Okay. So, but in current assets, inventory is not your monetary item, which can be readily available in the form of cash. Okay. So these are the monetary items, and non-monetary items, simply fixed assets, including inventory as well. So non-monetary items which are not in the form of cash and cannot be easily converted into the form of cash are non-monetary items. So items that give no right to receive or deliver cash, that is inventory, plant and machinery. So fixed assets are those assets which are not not giving you any right to receive cash are non-monetary items. When you are having an inventory, it is not giving you any right to receive the cash. You are having inventory, you can sell it and you can earn cash, but it is not readily giving you any right to receive cash. So it is non-monetary. So non-monetary item are all those items which are not in the form of cash and cannot be easily converted into the cash. And monetary items are all those items which are already in the form of cash or can be easily converted into the cash. Then we have currency. Under currency, we have to discuss about two types of the currency: functional currency, and presentation currency. What is the functional currency? Functional currency is a currency in which the major operations of the organization are being done. It is a major currency in which most of the transactions of the company are being done. So you have to see that in which currency major operations and activities of the organization, or the activities or the transactions of the organization, are taking place. That is a functional currency. And presentation currency. Students, functional currency cannot be every time the home currency. It doesn't mean that where the organization head office is there, that particular currency is functional currency. Functional currency is the one in which the major activities of the organization or the transactions are taking place. And presentation currency. Presentation currency is the one in which the organization is presenting its financial statements. So it's a currency in which the organization is making its financial statements. So they say functional currency, the currency of the primary economic environment in which an entity operates. This will usually be the currency in which the majority of an entity's transactions take place. Now, the basic definition provided by IS 21 for functional currency is that the currency of the primary economic environment within which the entity operates. So students can get confused with this definition that functional currency is the one in which the head office, it's the currency of the place in which the head office of the company is present, but it's not the case. It is a currency in which the major transactions of the company are taking place. And presentation currency, the currency in which the financial statements are presented. Now, they have explained all of the types of the currency. Let's have a look. Functional currency. IS 21 says that an entity should consider the following primary factors when determining its functional currency. As I have told you that functional currency is not always the home currency. So what factors you have to consider? Because in the examination questions, you have to determine by yourself that what is a functional currency. They will be giving you different currencies. So you have to consider by yourself that what is the functional currency. The currency that mainly influences the sales price for the goods and services. So the prices by which the sales, the currency rate by which the sales and the revenue of the organization is being influenced is the functional currency. Okay. So say for example, if over here in UAE you are running any kind of a business and the sales revenue, the sales price of the goods which you are offering in the market are being influenced by the amount of the raw materials which you are taking from the USA, then your functional currency is US dollars, not AED. Okay. So the currency that mainly influences sales price of the goods and services, the currency of the country whose competitive forces and regulations mainly determine the sale price of the goods and services. So say for example, the market, you do scan the external environment as well with the help of Pestel analysis and the Porter 5 forces analysis. Do you remember both of those? So the currency, the functional currency is the one of the country in which you are scanning the external environment. If say for example, you are sitting in UAE, but you are analyzing the US environment, so that we see that which factors are going to influence your organization. It means that your functional currency is US territory. And the currency that mainly influences labor, materials, and other costs of providing goods and services. So simply sitting over here, if you are taking the laborers from the USA, your laborers are working in USA, your raw material is being taken from USA. Your overheads, you are taking purchasing electricity from USA, then your functional currency is also US dollar. If the primary factors are inconclusive, then the following secondary factors should be considered. If in the examination question, they're not giving you any information regarding primary vectors, then you are going to determine your functional currency with the help of these two particular points. The currency in which funds from the financing activities are generated. What are the financing activities, students? What are the financing activities? Two important financing activities are there: taking a debt or taking an equity. So if no information is being given regarding the primary data, then you have to consider that in which particular currency the organization is making a debt financing or the equity financing. The currency in which the organization is taking its debts and its equity, that will be known as the functional currency. And the second one, the currency in which receipts from the operating activities are retained. What are operating activities? The major operating activities are sales revenue, or the wages, or any kind of the direct income. So the currency in which receipts from the operating activities are being retained, the currency in which the major sales revenue is being generated, will be known as your functional currency. Now, students, mechanics of the translation. You have to translate your currency. If, say, for example, your head office is in USA, but you are having a subsidiary in UAE as well, then obviously, while making your financial statements in USA, you have to translate the currency as well. You have to translate AED to US dollars. This is known as translation of the currency. Converting one kind of the currency into the other is translation. So what are the mechanics of this? Obviously, you have to think about initial transactions, settled transactions, and unsettled transactions. In currency translation, we have to see from three perspectives: initial transactions, at the time of initial transaction, what we have to do in the case of settlement of the transactions, and what we have to do when the transactions are not being settled. Initial transactions. At the time, this is initial measurement. At the time of making a transaction, how are you going to account it for in your books of accounts? When you do make an initial transaction, when you are selling something, what is the accounting entry? Debit, receivables, credit, sales. So at this time, what amount you have to write in the front of this transaction? This is the initial transaction settlement. This is the initial translation. So translate using the historic rate prevailing at the transaction date. So you are going to see that how much exchange rate at the spot is present in the market. According to that, you are going to translate it. Clear? The average rate can be used if it does not fluctuate significantly during the accounting period. You can use, instead of using the historic rate or spot rate, you can use the average rate as well if it is not fluctuating, at a very higher pace. Anyhow, I suggest you to take the spot rate. Whichever rate they will be giving you in the examination, if they have given you spot rate, you can go for spot rate. If they have given you average rate, you can go for that as well. If they have given you both, then you have to use spot rate. Okay. If the transactions are being settled during an accounting period, some transactions are going to be settled during an accounting period. For those transactions, what you have to do, when the transactions just settle in the accounting period, the accounting entry is cash debit, credit, receivables. What amount you have to write in front of this accounting entry? Let's see. If a transaction is settled, payment or receipt occurs during an accounting period, then once again, what you have to do, translate at the date of payment, receipt using historic rate prevailing at that. Now, what you have to do, you have to translate the currency again at the spot rate in which the transaction is being settled during an accounting period. When transaction has been made, at that time you have translated the transaction at the rate which has been prevailing at that. If the transaction has been settled during an accounting period, once again you are going to translate your transaction as per the prevailing rate at that settlement date as well. Now, obviously, at this date, there can be a difference as well. There can be a difference in the exchange rate also. If, say, for example, at the time of making the transaction, the spot rate has been 1.2, and at the date of settlement of the transaction, in the case of the sales, the spot rate is 1.1. There could be a loss. Is it? Of $0.1, there the loss could be there. So they say as this may be different to the initial transaction, an exchange difference may arise. That difference has to be posted to the statement of profit or loss. That gain or loss which has actually been arised has to be posted to the statement of profit. Got it? As an indirect income or an indirect expense, not the direct. Sales revenue is the one which you have recorded at the time of the transaction. Now the gain or loss due to the exchange rate fluctuation is arising will be posted as an indirect expense or an indirect income in your SOP. So this is the first case which you have to keep in mind. So isn't it simple? Very simple. Let's do this transaction. To this question, requirement. Record the journal entries for these transactions. You just have a look at this question and try to do it by phone. You have to show the initial measurement and the measurement at the settlement date. The settlement is during an accounting period. The chromits have to be converted into the dollar since the functional currency is dollar. Two minutes for you students, do it quickly. Okay, let's start doing this question, students. On 1st April 2008, Collins Company, a company that uses the dollar as its functional currency, students, the functional currency which has been given to you, in that you have to translate the transactions. That is why it is necessary to determine the functional currency. So on 1st April 2008, Collins Company, a company that uses the dollar as its functional currency, buys goods from the overseas supplier. From the overseas suppliers, the goods have been purchased. The accounting entry is debit purchases, credit payables, credit sales, debit purchases, credit sales, debit purchases, credit payables account. So on 1st April 2008, Collins Company has purchased the goods. Buys the goods from an overseas supplier who uses chromits as its functional currency. Now, chromit is the functional currency for the overseas supplier. You have to convert it into US, is it? So the goods are priced at 54,000. 54,000 chromits have to be purchased. This 54,000 has to be converted into the US dollars using the spot rate. What is the spot rate? It's the rate at 1st April 2008. The transaction has occurred on 1st April 2008. So this has been the spot rate. Is it? So 54,000 chromits have to be converted. 54,000 chromits have to be converted into US dollars. In every US dollar, there are 1.8 chromits. So 1.8 is going to be divided by 54,000. So how much dollars you are going to get now? This will be converted into dollars. Sorry, 30,000, 30,000. So at this time, the transaction will be recorded at 30,000. Is it? Now, the goods are priced at 54,000. Promise payment is made 2 months later on 31st May 2008. On 31st May 2008, it has been paid. The payment has been made. At 31st May 2008, you can see the exchange rate has dropped. It's 1.75. So again, you have to see how much it is going to be. 54,000 transaction price has been there, and the rate is 1.75. Now the transaction will be settled at which amount? 30,857. This is the settlement transaction. So at the time of the settlement, debit will be payables account and credit will be cash account. Cash has been paid. How much cash is being paid? 30,857. Is it? Now, is it a profit or is it a loss? It's a loss. You are paying more. You are paying more. The transaction has been for $30,000, but you are now paying 30,857. So at this date, 31st May 2008, accounting entry will be passed as debit loss on exchange. Credit would be, what are we going to credit? Students, what are we going to credit? What are we going to credit? What do you think? Sorry? Receipt? Receipt, profit and loss. It has to be posted to the profit and loss. Loss has to be posted. Now, one more thing. This transaction has to be changed little bit. It could be passed in this manner as well. Debit payables with the same amount which we have credited first. It would be debited with 30,000. Debit would be loss on exchange. That is 857. And credit would be cash account. That is 30,857. This loss will be taken to the SOP. At the time of the transaction, the payables in the current liabilities, SOFP, should be this one. Okay. So these are going to be the transactions, journal entries. Shall we move on? Now, students, in the case of the unsettled transactions, there are few transactions which are not going to be settled during an accounting period. Say, for example, in the previous question, what we have observed that during an accounting period, the transaction has been settled. But this could not be the case in every situation. Few times we see that the accounting period has been ended, but we have still not paid for the transaction. So in that case, the transactions would remain unsettled. In that case, what we have to do, initial measurement would always be on the spot rate. If at the end of the year we do find that the transactions have not been settled, we are going to translate those transactions once again by using which rate? By using closing rate. By using closing rate, we are going to translate them once again. So let's see what they say. If a transaction is still unsettled at the reporting date, there will be an outstanding asset or liability on the SOFP. Obviously, when your transaction is not being settled, the receivable or the payable which you have recorded will remain still. It is also going to remain still over there. If the asset or liability is a monetary item, it should be retranslated at the closing rate. So, now one more thing you have to consider. If the item for which the transaction has been made is a monetary item, is a receivable or a payable, or a loan is a monetary item which is which can be readily converted into the cash form. If it's a monetary item, then it should be translated using a closing rate. The rate at the reporting date, it has to be retranslated. But if it's a non-monetary item, then it should remain at the historic rate. If it's an inventory or any other non-monetary item, any other kind of the fixed asset like plant and machinery, it is not going to be changed. It will be remaining at the historic rate. Clear? If the asset and liability is the monetary item, then it has to be changed by using the closing rate. If it's a non-monetary item, it is going to remain at the historic cost. We are not going to change it. Exchange differences will arise on the retranslation of the monetary items, and these are also posted in the statement of profit and loss. Exchange and losses, gains and losses have to be posted in the statement of profit and loss. Understanding number 2, students. Start doing this question. Record the journal entries for these transactions. Yeah, great. On 1st January 2006, Wilkie Company, a company that uses the dollar as its functional currency, buys goods from the overseas supplier who uses dinar as its functional currency. These goods are priced at 35,000 dinars. The payment will be still outstanding at the reporting date of 31st March 2006. So students, simply on 1st January 2006, the purchases have been made, debit purchases and credit payables account. How much amount has been there? 35,000 dinars have to be converted into the dollars, since the functional currency of the purchaser is dollars. So how are we going to convert it? 35,000 using the spot rate. Spot rate is on 1st January 2006, it's 1.75. How much it is? 20,000? $20,000. And at the reporting date at 31st March 2006, 31st March 2006, it's still unsettled. At that date, what is the exchange rate? Exchange rate has been increased. So 35,000 divided by 1.9. How much it is? 18,431? 21. It means that the closing rate, because of the closing rate, payables have decreased. Am I right? The payables have decreased. They were 20,000, but they have now decreased to 18,421. But they are not settled. They have just decreased. In that case, decrease in payables, decrease in liabilities has to be debited. Is it? And credit will be the gain. Gain on foreign exchange rate. How much gain will be there? 20,000 minus 18,421. How much? 1,570. This is gain. Gain is credit. Now, in financial statements, what is going to happen? Gain will be reported in SOPL, whereas in SOFP, payables are going to be reduced by 157. These are going to be the two treatments in our financial statements. Yeah. Now, students, this is all for today. One small concept is left. We are going to discuss it in our next class. We are going to do this understanding. Understanding number 4 will be your homework. So this is all for today. If you do have any questions, you can ask me. No questions? Yes, my online students, any questions?
No, miss. Thank you.
No, ma'am. Thank you.
Okay, students. So goodbye, everyone. Take care.
You too,
Goodbye,
miss.
ma'am.
Bye.
Bye-bye.